All right, let's get started on Chapter 1 for Accounting 211. Just a general introduction to accounting and business. We're going to talk to you about the definition of accounting, why accounting is important. Um, First off, we need to understand that accounting is an information system. We take raw data, we take information from receipts, from payroll registers, lots of different places, and we decide whether that information is really relevant to what we do, and then we're going to start to organize that data so that we can turn it into useful information. So you'll see here that we select transactions, we identify those transactions such as the sale of an iPhone. We record that transaction if we feel that it's relevant, which is basically just keeping a chronological log of the transactions, and then we communicate that information to other people. So we use financial statements. A lot of different reports actually can be used throughout all of accounting, whether you're in financial accounting or in managerial accounting. So who uses financial information? Well, a lot of people do in the business community. External users, such as people that we borrow money from, the people who own our company, the shareholders. Government entities want to know how much we've made so that they can tax us. Consumer groups, auditors, customers, the like. Internal users also, officers, managers, sales staff, budget officers, because they need to know, they need a report card on how they're doing. So accounting is called the language of business, right? Because all organizations, all businesses are going to set up this information system. We keep coming back to that. What is accounting? It's an information system that helps us communicate that data. Why do we want to communicate it? Because people want to use that data to make better decisions. There are a lot of different jobs in accounting. I had someone recently ask me what kind of jobs can you get if you get a business degree? And that list is even bigger because business, of course, incorporates accounting. But just in the accounting industry alone, you can see that there are several different occupations that you can choose between financial accounting, managerial accounting, and then there's taxation and other accounting related types of jobs. All right, so we can't really talk about money without talking about ethics. And why is that? It's because money likes to grow legs and walk right out of your pocket and into somebody else's sometimes. It's an unfortunate truth that fraud exists, which means that criminal activity exists. So accountants have to be extra diligent in their decision-making process. It's very, unfortunately, very easy for an accountant to be swayed in the wrong direction. You got to think about what happens with an accountant. We're taking data and we're reporting information so that perhaps you could get a loan. So we help a client put information together, and then the bank goes and loans them a bunch of money. But if we didn't report that information honestly, and the bank made that loan in good faith that the accountant did his job appropriately, then the bank might be out a lot of money when this person can't pay off their loan. Well, why in the world would an accountant ever want to do that? Well, most likely because the accountant is getting paid to prepare those financial statements. So there's a lot of ethical decisions that have to be made when you're an accountant. We're commonly faced with ethical decisions all the time. A client wants to just fudge a number on a tax return a little bit, but that's defrauding the government. So there's just a lot of different opportunities to do things wrong. Therefore, ethics is a big topic in the accounting industry. In fact, certified public accountants must take 2 hours of ethics courses every single year in order to maintain their license. Not once every 3 or anything like that, but every year. We have to take new and updated ethics courses to maintain our license. This is just a very broad view of an ethical decision-making model. Identifying the concern, analyzing your options, the good and bad consequences, and then making an ethical decision. We have to talk about the fraud triangle because, again, fraud unfortunately does exist. And what this slide is telling us is that the triangle has 3 sides, or at least if 3 things can exist, 3 factors exist, then most likely fraud is taking place. Most likely. It doesn't mean that it's always taking place, but it is most likely. So if a person has the opportunity to commit fraud, the financial pressure to commit fraud and the rationalization to commit fraud, then most likely fraud may happen. What's rationalization? I feel like I've earned it, right? You don't pay me enough, but I feel like I earned it, so I'm going to steal a couple extra bucks from the cash drawer. What's the opportunity? There are no controls. No one is counting the drawer after me. I basically collect all the money from the customers. I make the deposit ticket. I take it to the bank, and nobody ever looks at it. That's opportunity. And financial pressure is that I'm working 10 hours a day. I got 3 babies at home. I can barely feed them. That's financial pressure. So if you put those 3 things together, you may have some fraud problems. All right, so we got to talk about generally accepted accounting principles. I'm going to tell you that generally accepted accounting principles is lovingly deemed GAAP, G-A-A-P. Accountants love acronyms. You'll find that out throughout this course, but there's GAAP. GAAP is basically the governing rule, right? It makes our information relevant, reliable, and comparable. So let's just think about that for a second. Accountants provide information to end users. It's an information system. Well, what is good information? Good information is information that is relevant, reliable, and comparable. Let's talk about relevance. It means that it has meaning to the decision that we might make. If it doesn't, if it's irrelevant to the information, then why are we worried about it? We shouldn't even be considering it. I'm going to consider a receipt for Apple, but I'm not going to consider a transaction that contains the warranty that I didn't have to pay for, because if I didn't have to pay for it, it's irrelevant. What's reliable? Reliable is information that can be trusted. If you can't trust information, you won't use it, and therefore it's not useful. And then what about comparable? Well, comparable information is something that helps you make a decision. It means that the information is reported in a format that you can set next to other information, and you're reading apples to apples and not, apples to mangoes, right? You can actually look at it and decipher it and make a decision based on it. There are some international standards. So here in the United States, we use generally accepted accounting principles in the U.S. You'll see that at the bottom of the slide where it says differences between U.S. GAAP and IFRS. Well, what's IFRS? Well, that's International Financial Reporting Standards. The truth is, at the moment, the U.S. is the only one that's using U.S. GAAP, and all the other countries in the world are using IFRS. Why is that? Well, because in the U.S. we're a bunch of bullies and we think that we should be able to do it our way. Truth of the matter is we don't like change very much, and it's taken us a long time to get this to a place where we can, get along with others, I guess, is the best way to say it. So the International Accounting Standards Board is the one that creates IFRS. And there's a few differences in how we treat things and how we look at information. For about the last 20 years or so, we've been working on convergence. The United States has finally said, okay, we understand we're now in a global economy and we understand that we need to get along with everybody else. So can you meet us in the middle? So the IASB and the FASB, which is the FASB is the U.S.'s Financial Accounting Standards Board, have been working together for years on convergence, and we're actually getting very close. What that really means is that everything that you learn within the next 5 years in accounting courses in college won't completely be thrown out the window, but it will be changing quite a bit. All right, here's a conceptual framework on that very convergence that we were talking about. We basically have broken all of our rules basically down into 4 different categories and how we look at it. And that's really the difference between IFRS and GAAP. Is that IFRS is more principles based. If you look at a desk and you say, all right, how much is that desk worth on our books? IFRS wants to use an appraisal value. What will someone actually pay you for that desk? And that's what gets recorded in the book. So it's principles based. There's a lot of gray area in IFRS, whereas US GAAP is very rules based. It's very black and white. Everybody does it exactly the same way. There is no objectivity in it at all. You paid $200 for the desk. Therefore, $200 is what goes on the books, even if the desk is really worth $3,000. So that's the difference between the two. So in GAAP, and these are just a few of them, please do not think that this is what makes up all of generally accepted accounting principles. We have the general principles, and you see that bracket right there on the left. So 4 principles here we're talking about: measurement, full disclosure, revenue recognition, and expense recognition. And these are the basic concepts and guidelines that we use to prepare financial statements. And where does it come from? It comes from a lot of history. GAAP has been developed over years and years and years of use. And then you get into specific principles, which are very detailed rules. So down below these general principles come specific principles, which tell you exactly how you should measure a transaction. With all of the GAAP, we have to have assumptions such as going concern, monetary unit, a time period, and business entity. And then we also have to have constraints. And constraints basically allow you to override the principles if necessary. Let's talk just a little bit about those 4 primary principles. The first is the measurement principle or the cost principle. And that tells us that accounting information is based on real cost. That's the example that I just gave you with the desk. If I paid $200 for the desk, then the desk is going to be worth $200 on my books, no matter how much someone is willing to pay me for it. Okay, so that's the cost principle. Whatever you pay for it is what it's recorded at, and nothing more, nothing less. I'm going to jump down to full disclosure principle because I want to talk about the other two together. Full disclosure principle says that any information that we know about that would impact a user's decisions about the financial statements must be disclosed. So you can report numbers all day long, but never tell a reader of the financial statements that the EPA has come in and you might get fined $250,000 because you were dumping sewage in the river, right? Do you think that a reader of your financial statements, that their decision may be affected if they know that you may have to pay a $250,000 fine at some point in the future? And I think the answer is absolutely it would. But that $250,000 hasn't happened yet, therefore it's not recorded anywhere in our books monetarily. So that's what the full disclosure principle says, is that if we have something like a contingent liability, such as this EPA fine, we must disclose it in our financial statements. Basically, we have to put it in the notes or in the details behind those statements. All right, so let's talk about the revenue recognition principle and the expense recognition, or what we like to call the matching principle. You'll hear me refer to it much more as the matching principle. We'll start here because this makes it a little bit easier. Revenue recognition principle says that all revenue is recognized when it's earned, not when you get the money from the customer. So the proceeds don't have to be in cash, but when you send an invoice to a customer and it says you owe me $500, that's when you're going to record that $500 sale, right? So recognize revenue when it is earned, regardless of when you get the money. And then we measure revenue by cash received plus the cash value of items received. What does that mean? It means that revenue is going to be the actual dollar amount of cash that you receive. So if you got $12, then you have revenue of $12. But if you also received anything that's non-monetary, someone gave you $12 and gave you a $500 desk, then you've got revenue of $512. But you have to earn it. Okay, so that's revenue recognition principle. Now let's jump down to the matching principle here. And this says a company must record its expenses incurred to generate the revenue reported. A lot of people struggle with this concept. And what this means is, if I'm running a business, and let's say I have phone service for my business. I'm sure most businesses do have phone service, and that phone service costs me $400 a month. And Verizon maybe sends me my bill on the 20th of every month, and I usually pay it by the 10th of the next month. Well, I need to record it in the month in which it relates to helping me get revenue, right? I'm in business to make revenue, right? That's why I'm in business, because I want to make a profit. Well, I needed my phone service in July in order to make revenue in July. So if I had a telephone expense in July that I didn't pay for until a later month, I need to record that expense in July. That's basically the overall principle. Another way to look at this would be, what do you think would happen if my rent were $12,000 a year, right? So the rent for my office was $12,000 a year, and it normally would be $15,000 a year, but my landlord gave me a few $1,000s off if I would pay it all in January. So I stroke a check to my landlord in January for $12,000 for my rent. So the question is, do I have a $12,000 expense in January, or do I have a $1,000 expense each month? And the answer is the latter. I have a $1,000 expense each month because I have to record the appropriate expense in each month that expense helps me earn revenue. That's a tough one. We'll keep working with it. All right, here are those assumptions that we talked about. So all of generally accepted accounting principles assumes these things. You have to make some assumptions. This one over here, the monetary unit assumption, says that all transactions are expressed in monetary units. We can't express it in stones or anything like that. It has to be expressed in a monetary unit. If you're wondering, if you've been watching the whole Bitcoin thing going on out there, Bitcoin's considered a monetary unit now. So absolutely, we could express transactions in terms of Bitcoin if it's considered a money. Right now, it's considered kind of like a foreign exchange or a foreign currency, so we convert it to actual dollars when we do financial statements. But it has to be, all transactions must be expressed in the same monetary unit on the financial statement. So if it's going to be in dollars, all of it's in dollars. If it's going to be in pesos, all of it's in pesos. The going concern assumption is the assumption that the business will continue operating rather than being sold or closed. Because if you don't have a going concern, if the business might change, you have to disclose that, and it may affect a reader's decision. But we always, if we don't say anything about it, then we assume that this business will continue. We always assume that a business is accounted for separately from transactions of its owners. As an example, a sole proprietor, if I go out and open up a lemonade stand in front of Germana tomorrow, then I'm a business, right? I own the business. It's me. I mean, when I collect money for selling lemonade, I put it in my pocket. But this assumption says that I should account for that money separately from my own money. So have a separate business checking account. You're not going to intermingle money. And then the time period assumption is going to presume that a life of a company can be divided into time periods that we understand, like weeks, months, quarters, years. So that's the time period assumption. Let's just talk about the types of businesses that we can be dealing with here. So proprietorship, partnership, and corporation. A business can take any one of these legal forms. And the proprietorship is the lemonade stand I just talked to you about. If you go out and immediately start selling anything or providing a service, even if you're a babysitter, if you go and start babysitting, you're a sole proprietor. You don't have to ask permission to be a business, but in reality, in the United States, if you are providing a service for money or selling a product for money, then you are a proprietor. So let's talk about that. Only one owner in a proprietorship, that makes sense. Your business is not taxed. All the profits of this business are taxed to you personally. You do not have limited liability, which means you are 100% liable for all of the debt of your business personally, not just the business. You are considered a business entity. The business, however, is not its own separate legal entity, and it does not have unlimited life, which means when you die, the business dies. A partnership is just like a proprietorship, except it has more than one owner, and it's that simple. So if Jack and Jill go start a lemonade stand, they're not a proprietorship, they're a partnership, and the rest of this is still the same. What's a little bit different with a partnership is that Jack and Jill have joint liability. if Jack goes and enters into a lease agreement with Germana to sell lemonade out front and Jill didn't know anything about it, Jill is 100% responsible for that lease even though she didn't know about it. And that's a tough piece in partnerships to deal with. Partnerships are a very hard type of organization. We see a lot of partnerships fail because people just can't get along. It's a lot like a marriage. A corporation is the other legal form, and there are some shoot-offs from this. You're probably thinking about, what about LLCs? What about sub-S corporations? And yes, those are all still entities. You can see that a little of that is listed down here. Proprietorships and partnerships are set up as LLCs, get some limited liability. But let's talk about this corporation. Look, everything changed to yes. More than one owner. The business is taxed separately from the owner. It has limited liability, which means the owner can only risk his investment in the business. It is a separate legal business entity, and it has unlimited life, which means when the owners die, the corporation is still in existence, just new owners take over. We got to talk a little bit about Sarbanes-Oxley, lovingly referred to as SOX. Congress basically passed the SOX Act in light of the Enron scandal, the WorldCom, Tyco, all of those kind of created this mess, right? But basically what it is supposed to do is help us curb financial abuses that are publicly traded. Not all corporations are publicly traded. Microsoft is publicly traded. McDonald's is publicly traded. Walmart is publicly traded. Apple's publicly traded. But Fultz & Associates is not publicly traded. So there's a lot of private corporations that are not publicly traded. SOX does not apply to those private corporations, only to public companies. And it requires that these companies apply accounting oversight and internal control, and that those internal controls be audited to make the owners and the accountants accountable for their actions and for their truthfulness. That's what SOX does. I would tell you that at the beginning of SOX, when it first came out in the accounting industry as a whole, we all thought that it was an overreaching regulation of the government, that they were going a little bit too far. But public scrutiny over the accounting industry had really changed with these scandals. A lot of people lost a lot of money, and it threw us into a recession. I mean, there's no question about that. It threw us into a recession. So in hindsight, any accountant who didn't like it at first probably now sees that it was a very good piece of regulation, without a doubt. The Dodd-Frank Wall Street Reform and Consumer Protection Act also came out at about the same time. It promotes accountability and transparency in our financial system. This is more about banks. It put an end to the notion of too big to fail, which means there's no more bailouts, right? We're not going to use taxpayer money to bail out banks who screw up. And it protects us, the consumer, from banks who are basically abusing their ability in the financial sector. Good act there. All right, so let's talk about the accounting equation, and this is really where we get into the basics of the accounting language, and you really do need to understand that accounting is basically a monetary language. And I would say that the accounting equation is kind of like learning how to say your vowels in Spanish, right? Every vowel only has one sound in Spanish versus English, where every vowel has about 3 different phonetical sounds. So this is the root or the basis of the accounting language, and it's presented to you in the form of an equation. And if you go back to your algebra classes and you think about what an equation is, an equation must be true. If it has that equal sign in it, then an equation has to hold true. So if I said that assets were 2 and liabilities were 0 and equity was 2, I would have a true equation. And that's really all we're talking about here, right? We're just talking about this equation. Can we move this equation around? Absolutely we can. We understand from algebra that if we take liabilities from this side and move it over here, then the equation would read assets minus liabilities equals equity. Okay, so it's no more difficult than that. We just have to understand what assets, liabilities, and equity are. So this is how it's kind of expanded out, but let's talk just a little bit about these big items. What do you think assets might be? Well, if you read your book, assets are the things that we own, right? That's our cars, the cash in our bank account, our buildings, our equipment. Even our accounts receivable, the things, the money that our customers own us, those are all assets. Our office equipment, our desks, our phones, those are assets, things that we own that have value to us. So what about liabilities? You might already think that liabilities just don't sound good because you kind of know what the definition of a liability is. A liability is your debt. It's what you owe to other people's. So asset is what I own, liabilities is what I owe, and then equity is what's left over for me. So again, if I restated this equation to say assets minus liabilities equals equity, then I would be taking everything I own minus everything I owe, and it's going to equal what's left over for me. That's what the accounting equation really kind of tells us there. Another way to say this, if you want to think about it, is that liabilities, your debt, is other people's claims on your assets. You're going to take a portion of your assets, most likely cash, to pay off these liabilities, right? I mean, because you owe this liability. So liabilities is a portion of your assets owed to other people, and equity then is a portion of your assets for you, right? Okay. That being said, let's talk a little bit about this expanded accounting equation. You see now that we're going to take assets, liabilities, but we're going to expand equity out. And we're going to talk about contributed capital and retained earnings. Well, contributed capital is the money that the owners put directly into the business. If I'm going to go start a lemonade stand, right, then most likely I had to take some of my own money to buy some powdered lemonade, some pitchers, some cups, and I probably got the water for free. I probably just took it out of the spigot on the backside of Germana, right? But I put my own money in it. So let's say I invested, $10 in powdered lemonade and a plastic pitcher and some cups. What's my contributed capital for my business before I do anything else? It's $10. I've contributed money to my business, okay? If you're a corporation, this contributed capital is called common stock. If you're a sole proprietor, contributed capital is called owner's equity. So contributed capital has several different names. So then we've got to talk about retained earnings. So equity is made up of contributed capital and retained earnings. Well, let's talk about this side of retained earnings first. Again, equity is what's for us, right? Well, why are we in business? We're in business to make money. We're in business to have net income or profit, right? That's synonymous. Net income and profit are synonymous. Well, how do we calculate net income? We take all of our sales minus our expenses, right? So all of my revenue or my sales of selling a product or a service minus the rent, minus the telephone expense, minus the payroll, all of that good stuff, all the stuff that it takes me to operate. This is why we're in business right here, right? Revenue minus expenses. So net income increases my retained earnings, and retained earnings increases my equity, okay? So let's then talk about dividends, and notice that dividends is preceded with a minus sign. So equity is contributed capital minus dividends plus retained earnings, which is made up of revenue minus expenses. So dividends come away, and if you think you know what dividends are, and you've probably heard this term before, it is a distribution of net income, which is the same as retained earnings, right? It's the distribution of profit out to the owners. So when I take money out of the company and give it to the owners, it comes out and is called a dividend. So equity then is going to be contributed capital minus dividends plus revenues minus expenses. So I told you this is a language. We have to think about it. This is kind of a great flashcard if you wanted to make a flashcard to just try to memorize this. This is very important when it gets down to how we enter transactions inside of accounting, how we do debits and credits, and record all transactions. This equation is extremely important, so it's something that you just really need to try to memorize. You don't have to 100% understand it right now, but you should try to at least get a visual of it in your brain to stay. All right, so let's just talk about transaction analysis. Remember that step one of trying to deal with all of accounting is to identify transactions and then to record them. So we've got to analyze transactions and kind of figure this thing out. So here we'll see that Chaz Taylor invests $30,000 in cash to start a company. Remember my lemonade stand and my $10? Same thing, except Chaz is going to start a company. He's going to take $30,000 of his own money to start it. So he's going to take $30,000 and put it into a business checking account. So what's happened? What accounts get involved in the accounting equation? The cash account, which is an asset, something we own, is going to increase in the business, right? And my common stock or my contributed capital, which is an equity account, is also going to increase. Let's look at how that looks on the accounting equation. He's starting a business called Fast Forward. So here is my overarching accounting equation, right? And I'm going to split it out into assets, into cash, supplies, and equipment. So these are accounts with an account type of assets, right? I've got two different liability accounts, an accounts payable and a notes payable, and I've got just the one equity account. So what happens in this transaction for Fast Forward? Does assets increase? Yes. Cash went up by $30,000 and my equity went up by $30,000 because this $30,000 was the owner's own money. Okay? So now is the equation still good? Yes, 30,000 equals 30,000. It's great. Right now, assets is 30,000, set equal to liabilities of 0 plus equity of 30,000. So the accounting equation holds true. Let's look at another one. The company purchased supplies paying cash. So what's going to happen? Cash is going to go down, right? And that's an asset, but supplies is going to go up. Supplies is also an asset. Everything's an asset until you use it up, right? So if you buy a whole bunch of paper, a whole bunch of pens, and stick it in a supply closet, that's considered an asset because it's something of value. That feels a little confusing. We'll work with it a little bit more. Let's see what it looks like in the accounting equation. And here it is. So now we're taking $2,500 in cash as a decrease, but we're going to increase the supplies account by $2,500. So you see what's happening here now. Now I've got $27,500 in cash, but $2,500 in supplies. Assets is still equal to 30 because this is a wash. It's an in and out, and nothing has changed on the right-hand side of the equation. Remember, this equation has to remain true. 30,000 still has to equal 30,000 in order for it to be a true equation. So let's look at another one. So it looks like Fast Forward purchased equipment for $26,000 in cash. So the accounts involved are, we're going to spend cash. That means we have an asset that decreases, and we now have $26,000 worth of equipment. That account has increased. Equipment is something that we own. It's something of value. So that's also an asset account. Here's what it looks like in the equation. Again, just like supplies, right? I've exchanged one asset for another. So while cash goes down, the value of the equipment account goes up. When I make this addition here, I still have 30,000. Nothing's changed on the right side of the equation. All right, so we purchased supplies of $7,100 on account. What are supplies again? Supplies are an asset. So that account is going to go up. It's going to increase because I've put more supplies in our closet, in our inventory closet. But I'm not paying for it yet. So I haven't paid for it. But I've purchased it. That's a relevant transaction that I must record. If I owe somebody something, I have to record it, right? Well, what we call our trade debt, right? So if we have debt for something that just keeps us in operation, we call that an accounts payable. And that's a liability account. So remember, liability accounts are things that we owe. So here I'm increasing an asset and increasing a liability. Look at what happens in the equation. So I'm increasing my supplies account by $7,100, but I'm also increasing the value of what I owe. So I no longer owe 0, I now owe $7,100. Is my equation still in balance? Absolutely it is. I increased both sides by $7,100. All right, so let's look at some transactions involving revenues, expenses, and dividends. I want to remind you, if you go back to the expanded accounting equation, revenues increase equity, right? Dividends decrease equity, right? We saw that minus sign. And expenses also decrease equity. If you go back to that expanded accounting transaction, it said that retained earnings was revenues minus expenses, and that's what gives us net income. All right, so let's see what this looks like. It looks like Fast Forward provided consulting services to a customer and received $4,200 in cash right away. Okay, so what happened? The cash account went up. That's an asset, right? We got the money. And then our revenues account went up because we sold something. And that's an equity account. So I have a plus on both sides. 4,200 cash, 4,200 revenue. So everything's in good shape there. Accounting equation is still in balance, right? So you see that this now increases equity, right? I no longer just have 30,000 in equity. I now have 34,200. And doesn't that represent the owner's share? Absolutely. Doesn't this represent someone else's share? Think about it. 41,300 is the value of everything that I own. Everything that I own. $7,100 of that belongs to someone else. 34,200 of that belongs to the owner. Okay. I paid rent of $1,000 and I paid salaries of $700 to employees. By the way, the word paid implies that we paid cash, okay? So just kind of understand that going forward. If it says paid, it means that we paid it. We don't owe it anymore. So the accounts involved are, one, we paid cash, right? So cash is going to go down. We paid for rent, and while the rent expense account is going to increase, that is a decrease in equity. And you might be like, oh man, what do you mean? It means that we need to keep an accounting of how much rent we pay throughout the year. So an expense account in and of itself is going to increase with transactions, right? But that whole account overall is going to decrease equity. And this is where it starts to get hard, right? You might be going, oh no, don't worry about it yet. I don't expect you to understand it just by looking at this slide. It takes time. For some people, it takes years to completely understand this. I'm going to help you get through there just by the rules. Here it is again. The balance in the expense accounts actually increase. So the balance in the expense account by itself, if you just think of a piece of paper where we're just trying to track rent, right? Every time we post another rent payment on that piece of paper, we're going to add it all up. So the rent account increases, but overall, that account is going to decrease equity because expenses reduce equity. See what it looks like in transaction analysis. Does it still fit the bill? Cash goes down by 1,000 and 700. It was rent and payroll, right? So it goes down by 1,000 and 700. So what does it do to equity? It's going to decrease equity. So they're over here as negatives, right? 1,000 and 700. That keeps us in check down here for the accounting equation. But basically these two numbers added together, right, are now in the expense account. So you might say, well, that doesn't add to the expense account. It takes away, but it's a bigger negative, right? It's a bigger negative in that account. All right. We provided consulting services of $1,600 and rent facilities for $300 to a customer for credit. So we're providing services to customers here, total of $1,900 for credit. Okay, that's what's a little bit different here. We're not being paid. So we have an accounts receivable. When our customers owe us, that's called an accounts receivable. When a customer owes us, that account's going to increase, and so is our revenue. So our revenue account's going to increase, and then we're going to have rental revenue because we're renting out facilities. All of them are on the increase. How does that look in the accounting equation? Well, here it is. Customers now owe us $1,900, and then here in revenue, I had $1,600 and $300, one for consulting and one for rental income. The accounting equation is still in good shape. Okay. The client in transaction 8 pays us $1,900 for the consulting services and the rent. The customer that owes us the $1,900. So now they're paying us. We're getting the money. Cash is going up. But are we going to record another increase to equity? And the answer is absolutely not. Didn't we already put the $1,900 in equity? Remember, it was $1,600 and $300. So we can't put it in equity again, but what should we do? Well, we have accounts receivable in the books. That tells us that a customer owes us money. We need to now take that accounts receivable off the books. The customer doesn't owe us that money anymore because they paid us. Let's see what that looks like. And here it is. So they paid us the cash, but now they no longer owe us this $1,900 receivable. Now that brings accounts receivable. So this washes out. Nothing else is going to happen over here on the equity side. See, that just stays there like it was. That was from this transaction. Okay, still in check. All right, fast forward is going to pay $900 as a partial payment for the supplies purchased in transaction 4. Remember that supplies that we owe? I think it was like $7,100 or something like that. We're going to pay $900 towards that. We're not going to pay the whole thing, right? We're just going to pay a piece of it. Maybe they allow us to do that. Maybe it's like an in-house account. Cash is going to go down, but so is accounts payable because I no longer owe that $900 anymore. So I get to decrease that account. Here's what it looks like. There's the cash going down. Here's accounts payable going down. See, I no longer owe $7,100. I now owe $6,200. Okay, so it's a partial payment for that supplies purchase, and that still keeps our equation in check. We must always keep this in check. All right, how about dividends of $200 being paid to shareholders? Remember, that's an equity transaction, right? We're actually taking some of the profit that we've made and paying it out to our shareholders. Cash is going to go down, but the dividends account, while the dividends account increases, right, the same as an expense, the dividends account will increase, but it will reduce our overall equity. Here's what it looks like. There's the $200 in cash, and then there's the $200 dividend going out the door, and that keeps us in check. But the account overall is increased by a negative number of 200. Okay, let's talk really for a moment about the financial statements. We're almost done. I know this has been a lot of information. The good thing about a YouTube video is that you can pause me, you can back up, you can slow down as much as you want. I'll go back through it. So let's talk about financial statements and how they interrelate. Here are the 4 financial statements that make up a financial package. They are required statements. We have the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. We're going to cover 3 of these throughout the entire semester, but the statement of cash flows, while we're going to touch on it a little bit now, there's an entire chapter dedicated just to the statement of cash flows in chapter 12. So the income statement, that basically is the report of our revenues minus expenses to result in net income or net loss. If expenses are bigger than revenues, you have a net loss. If revenues are bigger than expenses, you have net income. And it's always over a period of time, right, due to earnings or operating activities. Always over a period of time. So we can say this is my income statement for the month of January, or for the first quarter, or for the year of 2018, right? Always, it can be for a period. The statement of retained earnings is kind of like a supplemental statement that explains the changes in equity because we had income and because maybe we paid out some dividends. So it's going to show that our equity account increases by net income or decreases by net loss and decreases by dividends, again, over the period of time. The balance sheet is basically going to show us the value of the accounting equation. So the balance sheet is going to have a section for assets, a section for liabilities, a section for equity, and then it's going to total liabilities and equity together, and that total must be equal to total assets because that's the accounting equation, right? It's always going to be a snapshot of time, right? It's going to be a specific point in time. Think about it. You can't say, how much cash did you have in the first quarter? It doesn't work. You would immediately say, on what day in the first quarter, right? You can't do it for a period. It has to be a snapshot in time. What was your equipment worth in the month of September? You can't do that. What was my equipment worth on what day in September? So a balance sheet is always going to be a point in time. And then the statement of cash flows identifies our cash inflows separate from our cash outflows. And the real difference is, you might say, well, isn't that an income statement? Absolutely not, because the income statement, remember, shows you revenues, whether you've been paid for them or not, and shows expenses whether you have paid for them or not. So the statement of cash flows will only look at cash transactions, not the revenue recognition and matching principle. Real quick, just some information about US GAAP and IFRS, the differences between them. I'm not going to read through this. I'm going to let you do that on your own. This very page is in your book and, of course, in the PowerPoint slideshow as well. So it just gives you an idea of some of the differences in the principles between GAAP and IFRS. Same thing with transaction analysis. Again, remember that I said that GAAP is much more rules-based. IFRS is much more principles-based. So definitely want to take a look at that. And then the differences in financial statements. We all use the same basic 4 financial statements: the income statement, statement of retained earnings, balance sheet, and statement of cash flows. By the way, they have to be prepared in that order. There'll be more about that in Chapter 2. But we have some differences in how we present those. And that, folks, is the end of Chapter 1.